Today, we're diving into a foundational concept in technical analysis that every trader, whether you're a beginner or a pro, absolutely needs to master: trendline support and resistance. Think of these as the roadmap for the market. They help you understand where the price has been, where it might be going, and key areas where it could bounce or reverse. Getting this right can seriously level up your trading game, so stick around. First up, what exactly are trend lines? Simply put, a trend line is a straight line drawn on a chart that connects a series of prices. In an uptrend, where prices are generally moving higher, you draw the trend line by connecting the swing lows. Imagine a series of higher and higher valleys. Your line goes right underneath them, acting as a sort of rising floor. This is your uptrend line. Conversely, in a downtrend, where prices are falling, you connect the swing highs. Picture a series of lower and lower peaks. Your line goes right above them, acting as a descending ceiling. This is your downtrend line. Why are these lines so important? Well, they give you a visual representation of the market's momentum. As long as the price stays above the uptrend line, the bullish momentum is considered intact. If it starts to break below it, that could be an early warning sign that the trend is weakening or about to reverse. The same logic applies to a downtrend line. As long as the price stays below it, the bears are in control. A break above it could signal a potential shift in momentum. Think of it like a ball rolling up a hill. The trend line is the ground beneath it. If the ball breaks through the ground, something has changed. Now, let's talk about support and resistance. These are horizontal price levels, not diagonal lines. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. In simpler terms, it's a price floor where buyers tend to step in and push the price back up. Imagine a stock is falling, but every time it hits $50, it bounces back up. That $50 mark is a support level. It's an area where the market has previously decided, this is cheap enough, let's buy. Resistance is the opposite. It's a price ceiling where an uptrend can be expected to pause due to a concentration of supply. It's a level where sellers tend to emerge and push the price back down. If a stock is rising but struggles to get past $60, that $60 level is resistance. It's an area where the market has historically said, this is expensive enough, let's sell. These levels are created by the collective psychology of the market. Previous peaks and valleys often become future support and resistance zones. So how do you find these levels? Look at the chart's history. Where has the price repeatedly bounced off from below? That's your support. Where has it repeatedly been rejected from above? That's your resistance. The more times a level has been tested and held, the stronger it's considered to be. A key thing to remember is that these are not exact lines, but rather zones. The price might poke through a little bit before reversing. Here's where it gets really interesting. The role reversal principle. When a resistance level is decisively broken, it can become a new support level. And when a support level is broken, it can become new resistance. Think about it. Once the price breaks through that $60 ceiling we talked about, traders who were previously selling at that level might now see it as a good place to buy on a dip. The old ceiling becomes the new floor. This concept is incredibly powerful for identifying potential entry and exit points. So, how do we put it all together? You use trend lines to understand the overall direction and momentum, and you use support and resistance levels to identify specific areas of interest for potential trades. For example, in a strong uptrend, you might look to buy when the price pulls back to either the rising trend line or a horizontal support level. In a downtrend, you might look to sell when the price rallies up to the falling trend line or a horizontal resistance level. Combining these tools gives you a much more robust framework for making trading decisions. Mastering trend lines, support, and resistance takes practice. Open up some charts and start drawing them yourself. See how the price reacts to these levels. It's a skill that will serve you throughout your entire trading journey. Thanks for watching, everyone. If you found this helpful, please hit that like button and subscribe for more content to help you become a smarter trader. Drop any questions you have in the comments below, and I'll see you in the next video.